Welcome back, traders and investors. We have Steve Claussen on, who's the Chief Investment Strategist at OptionsHouse. Steve, how you doing this morning?
Doing great, Joel. What's going on?
Not too much. Everyone at OptionsHouse handling that volatility from yesterday. We've seen the market seem to be getting moving pretty good there in the wrong direction.
Well, you know what? It's interesting, right? The market opened higher and was looking relatively good, and I think that surprised a lot of people just because there's so many worries in the market nowadays that people were surprised it was up, but probably pretty happy about it. I mean, most retail investors are generally have a long, positive, bullish, optimistic bias, but when it turns like that, it is a little bit surprising, and it is a little bit concerning to investors, and I think it really points out some of the just differences in philosophies of someone who looks at the market from a sort of a long stock buy and hold type strategy to someone who can probably apply some option strategies to express their views in the marketplace and maybe sleep a little better at night.
Okay, before we talk about getting out of the market or hedging in the market, let's just look at things from like a perspective of a new investor or someone that's invested in the market, has some money, that disposable income that that they want to are willing to put at risk in the market. It's not going to affect them. Their kids will still be able to go to college and stuff, and they have $10,000 to invest in a particular stock or a particular issue. I mean, stocks versus options there. Let's discuss that.
That's, I mean, I had started to almost chuckle when you said, they have some disposable money that they're willing to put into the market, disposable. And I know your point is you should never invest and you should never put capital at risk that cannot be afforded to be lost, right? Because investment does involve risk, whether you buy stock. I saw one of your guys chatted in saying, hey, can you talk about the risk rewards of just straight stock ownership? A lot of people talk about risk rewards of options. My specialty is options, so I tend to talk a lot about that actually. And we don't really talk about just the risk rewards of just stock ownership. But your point is a valid one that a lot of people, they earn money, and why do markets exist? They exist so that businesses can raise capital, and investors who have excess capital can invest that capital, right? And to be able to put those two things together, and it's a real efficient process that the securities market allows that to happen, which is really fundamentally one of the strengths of the U.S. economy. But not going into all that. But so say you have a piece of capital, what were you saying, like $10,000 or something like that you want to start to put to work in the marketplace, right? So if you're new to the markets overall, you can go out and say, hey, that's great. You got $10,000, you want to invest. You know that stocks outperform other asset classes, especially in this low interest rate environment we're in, than other asset classes. And so you're saying, hey, this is money I don't need in the short term. I want it to start working for me. I'm gonna put it to work in the market. Now, what do? Do you buy $10,000 worth of stock? Very well, that might be the case, right? You might say, hey, Microsoft, good stock. It's not going anywhere. I'm going to buy $10,000 worth of Microsoft stock. That's okay. They pay a decent dividend. But what have you done, right? You've concentrated your exposure in one stock. And one of the things that I see people, new investors making errors in is concentration risk. They concentrate in one stock where, what are the chances that the one stock they picked is, an outperformer of the overall market? You can pick an ETF, you can just, match the market, you can do things like that. But, if you're concentrated in one stock, one of the fundamental first tenets of portfolio theory is you want a little bit of diversification, and you want to hedge your exposures to whatever you decide to buy. And options can allow, a $10,000 portfolio, because they do employ leverage. Options can employ leverage, but you can spread that $10,000 around, with $2,000 investment in the money calls, for instance, instead of just a long stock position, and you could spread it around five different companies or 5 different ETFs or 5 different geographical areas, and using geographical ETFs. So you can diversify, using options. Now there's always benefits and costs of using options versus using stock, and we should probably delve into that a little bit
Yeah,
too.
what are some of the let's talk about some of the advantages of trading the options versus owning the stocks, and you also got to talk about some of the disadvantages.
Yeah, absolutely. Like I said, probably the number one advantage in using an option is you have the option, right? I mean, that's how they're named, right? If you buy a call option, you have the option to buy the stock. The biggest option that you have is you can choose not to buy the stock. Now, one of the things that's labeled as a disadvantage in buying in trading options, and especially trading options from the long side, is you can lose 100% of what you pay. Well, listen, when you buy $10,000 worth of stock, you can lose 100% of what you pay. You can lose $10,000 worth of your money if the stock goes to zero, and stocks, can go to zero. Look at Bear Stearns or WorldCom or Enron or whatever. And in options, one of the main advantages is you're spending less. Yes, you can lose 100% of what you pay. You're spending less than you would spend, the leverage you get, in an option trade versus buying the outright stock. Because you're spending less, your money at risk, your capital at risk is less. That's one of the main advantages. And you have the option. You can walk away. You have the option to buy, pick a stock, because I don't like picking stocks. But what stocks were you talking about earlier today?
Let's just talk about Disney here.
Disney, great stock. I actually own Disney stock in my kids' portfolio. My kids are all grown now, but it's done really well over their lifetime, right? Pays a dividend. But you can choose to go out and buy Disney stock. Disney now is trading at, where is it here? About $80. So if you bought 100 shares, that would be $8,000. Or you could buy the right to buy Disney stocks. Assume that you had a bullish stance on Disney stock, a bullish sentiment on Disney stock. You could buy the right to buy Disney stock at $75 a share, and essentially be able to spread out that instead of paying $8,000 for that, you could pay. Let's see where these things
Hey, Steven,
are.
we got to talk about this too. Is that when you do buy the stock, I mean, you have forever for that thing to go up, right? When you buy it, let's say you buy it at 80 here, you set your risk reward ratio. If it goes to 100, in 2, 3, 5, 6, 7 years, that's great because you own the stock outright. You're also getting the dividends during those times. But such a key element, like if you're buying the 82 calls here or something, you are restricted to that, to that time period, correct?
What are the two most important things in humor and in options trading? Go ahead and ask me that question. What is the most important thing in comedy, and what's the most important thing in options trading?
Steve, what is the most important thing in options trading?
Timing is critically important.
Okay.
Sorry, I massacred that one. But timing is critically important. And one thing that you pointed out is, hey, Disney's at $80 a share. If you bought the 82 and a halves, you're only paying a little bit of money, but you have to be right on timing, right? If you don't just own the stock, you can hold it for, your kid's just born, you can hold it till they're 16 years old. And you can hold it 16 years, and that's absolutely right. And one of the main, I guess we'll jump into a couple of errors that I see new options traders do, is they buy out of the money call options, right? Where you have to be so right on timing and you have to be so right on the move in order to make money, right? If I buy the 82 and a half call, the right to buy the stock at 82 and a half, it's not worth anything unless at expiration, unless the stock is higher than 82 and a half. I need it to go higher. And with most call option strategies, you're going to have a need for the stock to move a certain direction. Let's stick to the bullish side, but you're going to, you have a need for the stock to move higher. But buying out of the money options is ways that new retail options investors, their first trade, they get it. They go to a couple of classes. They listen to even one of my webinars, and except I never tell them to buy an out of the money option. and they take their $10,000, they buy $10,000 worth of option premium in the May 82.5 calls for $1.60. They can buy so many of those because $1.60 is $160. They have $10,000. They can buy 62 options, and then lo and behold, Disney doesn't move between now and May high enough past 82.5, and they lose their $10,000, and they go, options trading's terrible. It's so
Yeah.
risky. I lost all my money.
All right, let's
That's
take
the worst possible thing.
right. So the timing, you could do it. You could. There's a lot of other things you can do, and obviously, the more you go out, and the more that you pay up for that 82 and a half call or the 82 call, the more premium you're paying, and then the more time decay just kind of drip 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 every day. The stock may be moving higher, but if it's not moving with so you're in the money to your stock, your stock price. And then a lot of times I've had options. I bought these out of the options money, out of the money options. I've paid up at the premium, and then they finally get into your strike price, and you're thinking, wow, man, this thing should be going just tick for tick. And it doesn't. It doesn't, because it had all that value built into it when I bought the option.
Right, and so it's key. I mean, okay, so what I really, really stress is that someone that's new to options, they're relatively comfortable with stock. You want to create an options position that acts very much like a stock position would act like. If I own a stock and that stock goes up $1, I make $1. Say I buy 100 shares, I make $100. I know what I'm going to do. The stock went up $1, I make $100. I own stock. I know exactly what's going to happen. And what you're talking about, and we've been talking about buying out of the money calls. Do not buy out of the money calls. And not a buy, sell, or hold recommendation, but out of the money call options have a reliance on the stock to go through that strike, turn them into in the money calls so that they have some parity value at expiration. Why wait for that to happen? Why not buy an in-the-money call option, something that has what's called a higher delta, a higher hedge exposure, or higher relationship to the stock price now? And what someone that has a desire to own or to control the upside appreciation of a stock, buying an in-the-money call option, it's already in the money. You don't need it to already move to become in the money. It has an intrinsic value and it has an extrinsic value. It still has that extra volatility value that as time passes, tick, 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 that option is a wasting asset. The extrinsic value of the option is a wasting asset. Out-of-the-money options are 100% extrinsic value. They are 100% wasting asset. In-the-money options, the portion that's in the money, that is not a wasting asset. Parity does not decay. Extrinsic value decays. So I think it's critically important when someone listens and says, hey, I want to get into options trading. I want to go to a cocktail party this weekend and say, oh, yeah, I'm long the calls in XYZ stock. If you own a 70 delta option or higher, that option will move 70%. It's 70% of the risk of stock ownership. If the stock moves up $1, you would expect that option to theoretically increase 70% of that, or 70 cents. Acts much, much, much more like an option, much more like the stock, and that's much more in their comfort zone. So I definitely steer people towards, it's called the stock replacement strategy. Stocks are at near all-time highs now, right? And there's a lot of uncertainty in the marketplace. A popular strategy now that investors are considering is removing their long stock positions, replacing those with 70 delta call options so that you still have upside exposure, but you have 70% of the risk of straight stock ownership. And in fact, that 70 delta, that delta is a dynamic number. As the stock moves higher and lower, as the stock moves higher, that delta, that exposure, that percentage of stock exposure, that moves higher towards 100. If the stock were to move lower, that exposure moves lower. And in fact, if the stock falls below the strike price that you buy of the call option in the money, that at expiration, that delta becomes zero. That exposure becomes zero. Yes, that's terrible. You lost 100% of what you paid for the option, but that will typically be less than you would have lost had you been long the stock for that move lower.
Okay, so let's take the flip side of things here. And you said you're invested in Disney for one of your kids, correct? And you've been in it for quite a long
That's not
time.
a buy, again, not a buy, sell,
No,
or
no,
hold
no, no. I
recommendation. My
know, I
kids,
know. I'm sorry about that. I'm just trying to use this as an example here. The
absolutely.
House of Mouse. So you've been in this for a long time here. It's had an incredible run. And let's say your kid's going to college in a couple years, and you're getting a little bit nervous here. The market's declined. It's had a big run. Actually, if you look at Disney here, it's sitting on a mound of support here at the 79.50 level. Let's say you're getting nervous about this thing. You see the resistance at 82. You don't think it's going to make an all-time high, or at least you think it's going to sit still for a while. Without, you know, giving up your investment, without outright selling the stock, but covering some short-term downside potential, what are some potential ways? I mean, especially ahead of decline yesterday. You cannot ignore that decline in the market. You cannot ignore the breakdown in some of the leaders and the momos and the biotechs. You don't know when that's going to spill over to the rest of the market. How could you specifically hedge your exposure? Let's say, and I'm not saying you have 1,000 shares, but let's say you did. Let's say you had 1,000 shares of this and you bought it at $72, and you're sitting on all this profit here. What would be a way to approach that?
So you could do a couple of things, right? I mean, that same delta or that same risk exposure of stock, where I was talking about it as far as taking off my 100% exposure in Disney stock of 1,000 shares, I could replace that by buying an in-the-money call option. Maybe struck again, looking for a 70 delta call, looking at the May 75 calls. I could take some money off the table and replace my long stock with a long call option. But say I don't even want to sell the stock because I've been sitting on it a long time. I don't want to have a taxable event. I could keep my long stock, and that same delta, I can reduce my exposure to stock by actually selling a call option. And now that delta of that call option is being shorted or being sold, so I'm reducing my exposure of 100 or 1,000 shares of stock by the percentage that the delta is of the call I choose to sell. And now I am going to look at an out-of-the-money call option, right? Because I still want some upside potential. So you were saying there's some resistance at 83, and this is all hypothetical. So you might look at the May 82.5 strike calls and say, wow, those things command $1.60 premium. I can take in about $1.60 for those options, right? So if I add $1.60 to 82.5, if in fact the stock does scream higher, everybody decides they want to go to Disney World for spring break. $1.60 plus 82.5 is 84.10. My actual exit point, my obligation to sell my stock, would be up at $84.10, right? And if you look at 84.10 on a percentage basis from 80%, that's another 5% higher in the next 52 days. So if you annualize that, 5% in 82 days is
That's good. That's good.
That's good.
Yeah,
That's better than I'm making in my money market account.
Yeah, only.
And
like
then the other thing
$100.
that $1.60 does is it protects me. We look at it as sort of a downside protection, right? We've got $1.60 of downside protection in the stock from right here, right now. The stock sort of drifts around, drops a little bit lower, goes down to the 78 level from $80. $1.60 of that I get to keep in my account from that covered call or that overwritten call that I sold. So I've really only experienced a 40-cent loss because I have taken the obligation to sell it at a price that I'm relatively happy selling it at between now and May.
Right, but then also you got to look at it that below that $1.60, you no longer have downside protection in stock, and then if you want to take that strategy just a bit further, if you're really worried, but you still don't want to get low, get rid of the stock, you could buy a lower price put or put a put spread on.
Absolutely, and you're describing the collar trade, and then options. There's calls, there's puts. You can buy them, you can sell them, right? So there's four cornerstones, but you can create all sorts of strategies using combinations of the two. And so if I have $1.60 in my pocket, I can say, wow, I could spend this $1.60 on a downside put to give me a little bit of protection if the stock really gets ugly. That same, and looking in May again, that May 75 put is priced at $1.20. So I could actually buy that for a no cost or for a slight credit to me of 40 cents. I could buy the 75 put, protecting my stock position below the price point of 75. I've given up upside above 82 and a half. And I've taken in 40 cents. So it cost me nothing to hedge my exposure 5 points lower than here. So if it broke through that support level that you're thinking about and had a spike lower, if who knows what might happen in the marketplace. Yesterday's a perfect example of a day that starts off well and then kind of turns relatively suddenly and relatively deeply at one point, right?
Right, and and I don't know if you have access to this information, but I mean, you obviously see what the overall clients are doing and stuff, and from the order flow. I mean, and so far, all these dips have just, they've been bought. I mean, and that's been the trend, and the trend is your friend. We've had a higher market, a pretty big decline off the quad wedge expiration here. Did you see more aggressive, call buying overall yesterday? People taking advantage of the dip, or did you
Well,
see kind of like a shift in investor sentiment where hey, here, it's kind of time to lock in some profits?
I do think that that's a good point, and I do think that people are using more and more. They're using option strategies to express their views in the marketplace. Just because what happens if the next dip isn't bought, right? And there's no buyers below. You always expect, oh, there's a dip. It's gonna attract buyers, right? How do you find more buyers? You discount the price. What is really a sell-off in the S&P in the overall market? It's a discounted price, right? So what happens if there aren't buyers though? And I think that you're seeing more and more people moving to options to express their views so that they have hedged exposure to the downside. They either do the collar or they do an in-the-money call option so they don't lose any more money below strike if they are wrong. And you can just look at the volume numbers, the growth in options relative to, sort of a static increase in the amount of stock volume, is one aspect of sort of that migration using option strategies to express stock sentiment. But the key thing and the first thing is, and the biggest advantage, and I just want to leave your listeners with this, the biggest advantage that retail investors, it's never been a better time to be a retail investor in both options and stock. Markets are as tight as they've ever been. Commissions are as low as they've ever been. Transaction costs, the spread between the bid price and the ask price, is as low as it's ever been. But the biggest advantage that a retail investor has over a professional options market maker, which I was for 20 years, is they have an opinion. They have an opinion about the stock and the future direction of the stock. And I really encourage people to really use that advantage. And then start with that. Start with, an investment thesis or on an individual stock, on the overall market, on whatever, and use that advantage that you have, because a professional market maker, a professional options market maker, they try to have zero opinion about the future direction of the stock. They hedge away all the directional bias. Use options to give yourself a directional bias, but in a hedged and in a risk appropriate measure. Don't over leverage, and anytime that you can limit your potential gain. Seems a little counterintuitive. Limit your potential gain. You're going to increase your probability of success, and a higher probability of success will lead to longer term investment positive returns.
Okay, Steve, we have covered the whole gambit here from from getting into a trade, maintaining it, looking at the options versus the outright stock and the advantages and disadvantages of that. Then we talked about hedging strategies as well. And just how can our traders and your customers educate themselves on the OptionsHouse platform, and what do you suggest for them? Because we covered a lot of things here, and there's a lot more to learn. What do you suggest the best way of going about that is?
Most retail brokers, I know OptionsHouse Online, we have online webinars which we archive, and we start at the very basics, and we have intermediate strategies, and we have very advanced strategies. And most retail brokers online, they have a virtual trading account that you can try it out on. I would definitely suggest you have to be educated. You have to know what you're doing. Don't just poke and hope, right? Don't just say, oh, I know calls give you the right to buy. I'm going to buy a bunch out of the money calls and hope that the stock goes up. Do not do that. You need to get educated. So I think, listening to you guys every morning is a great start. Options House has online webinars and archived webinars that people can consult and reconsult and learn and get some education and always be educated before you invest in anything. Options do involve risk. They're different than straight stock ownership. You don't have the benefit of waiting forever when you have an options trade or an option strategy on. So definitely encourage you guys to. I mean, they're powerful instruments. They're wonderful instruments, but make sure people get educated before they try them with real money.
Right. The leverage is great on the upside, but leverage is even worse when it's going against you. So we've had Steve Claussen on, Chief Investment Strategist at Options House, giving us just some basic strategies that you should start to explore if you're going into the options market. Steve, I didn't even get through like half of my list of questions. Can you come back on again soon and do some follow up?
I'd love to. We need to probably, narrow down the focus and really dive in relatively deeply for, what the folks want to hear about. But we could go through some, common mistakes that early options traders make, some common things that successful options traders actually use. So I think that would probably be helpful.
Okay. All right. Thanks, Steve, and we'll talk to you soon.
Thanks, guys. Take care. Bye.